So I'll leave it like this.
So then let me see if the live stream this time works. Fingers crossed. All right, this time it seems to work. Okay, I'd say let's give people another minute and then we'll start. Okay, so then I start the recording. And just as a backup. Okay, and then let's start. So welcome everyone to today's session of the UCL InfoSec seminar. And it's my great pleasure to have Nicholas Christin with us today. And before we start, I would like to take a moment and say a few words about him. So Nicholas is an associate professor with tenure at Carnegie Mellon's University, where he's jointly appointed in the School of Computer Science and the Department of Engineering and Public Policy. Nicholas holds a PhD in computer science from the University of Virginia, and he was a postdoc at UC Berkeley before he joined Carnegie Mellon in 2005. His research interests are in computer and information system security, and most of his work is at the boundary of measurements, systems, and policy research. Most recently, he has focused on security analytics, online crime modeling, and economic and human aspects of computer security. And today, Nicholas will talk about cryptocurrency trading at 10, from monopoly money to $1 billion derivatives market. Nicholas, the stage is yours.
Thank you very much, Philip, for the introduction. It's a pleasure to be back to UCL, although it's virtual this time. I'm very, very, very happy to be invited to this seminar. It's always a lot of fun. And so some of you may know me as the guy who spends a lot of time investigating reasonably shady behavior on the internet over fairly long time scales. And so what I'm going to talk about today is the cryptocurrency trading ecosystem. And so if you go back 10 years ago, 12 years ago, cryptocurrency trading just didn't really exist at the time at any given scale. It was, something for hobbyists. And in fact, most of you are probably familiar with this post, which is the very famous, or rather infamous, Bitcoin pizza post from May 2010, so 11 years ago. where somebody bought 2 Papa John's pizza for 10,000 Bitcoins. And this seems ludicrous now. In fact, there's even a Twitter account dedicated to how much this person paid for those pizzas, which as of today is probably something around $360 million if you're applying today's exchange rate. But that's kind of missing the point, right? I mean, the point was that at the time there were no uses of Bitcoin as a currency. There was just very little trading going on. I think that the 10,000 Bitcoins at the time were worth about $40, if I'm not mistaken. So it was still, he actually overpaid for his pizza because he could have gotten it for like 25 bucks. But the point was that this was the first transaction. And it's only 11 years ago, right? So we started from nothing 11 years ago to if I fast forward 3 years later, we now have working marketplaces. I gave a talk at UCL a couple of years ago that actually dived very deep into those online anonymous markets. I promise this is the only slide that I'm reusing between the 2 talks. But the point was that this was actually a functioning marketplace. Yes, sure. I mean, everybody that was being sold there was pretty much illegal. I mean, as you can tell, I don't think that there is a single one of those items here that is legal in most jurisdictions. But we started seeing Bitcoin being used as a payment instrument, which was quite interesting. When we did this study of Silk Road, analyzing essentially the amount of money that was flowing through the marketplace, one thing that was actually quite interesting was that we compared it to what we could see being traded every day on exchanges, specifically Mt. Gox. And I did this at the time very much, back of the envelope calculation, really not something that is scientifically rigorous, but it seemed that in comparison, Silk Road was probably on a daily basis about 2.5 to 3%, maybe 5% of what was being transacted on Mt. Gox at the time, which was, quite interesting because this meant that however famous or infamous this marketplace was, it was really not the dominant use of cryptocurrencies, of Bitcoin in particular. The dominant use seemed to be just people exchanging money for US dollars or British pounds or euros, or trading and trying to use it as a speculative instrument. So if you fast forward to today, this is where really most of the action is. Yes, there are dark web markets and they've been flourishing. We've seen also other activities like ransomware, which was in the news just a couple of days ago because a fairly large amount of money was seized. But the main point is that today, most of the money in the cryptocurrency ecosystem comes from trading and speculation. And we're going to talk a little bit about spot markets, which are markets where people exchange US dollars or British pounds or euros for cryptocurrencies like Bitcoin or Ethereum. But what this graph shows is platforms that are mostly doing nowadays what's called futures or derivative trading. And this is the volume per day, and the B denotes billions of dollars. To give you a comparison point, about $100 billion per day is the notional value of the New York Stock Exchange. So you're talking about a market that is rivaling the New York Stock Exchange. The Nasdaq is about the same, in the same order of magnitude. Now, this comes with huge caveats because it's very, very hard to actually compute those notional values. And if there are some economists, specifically finance professors in the room, they're probably rolling their eyes right now. But this gives you an idea of the order of magnitude that we're talking about. So trading on exchanges is a big deal. That's basically the first thing that I want you to take away from this talk. For all of the headlines that you see about ransomware, about dark web markets, about reasonably shady behavior, that's a drop in the bucket compared to what is being traded every day on those platforms. And the second point that I want to make here is that spot markets are completely overshadowed by derivative markets. And I'll define those terms a little bit better in the coming slides, but the point is that those are fairly large amount of money. So we probably want to look a bit at the exchange ecosystem timeline. So if you go back to the days of the Bitcoin pizza back in 2010 or so, Mt. Gox was basically the name of the game, and there were a couple of others, CanBX and others that I'm not listing on this slide, that kind of emerged. And so you had this first set of exchanges, which are essentially spot markets. Again, what's a spot market? It's a place where you go and you take your hard-earned fiat currency, like the US dollar, and you exchange it for magic internet money like Bitcoin. I mean, this is really what was going on at the time, right? People would take their US dollars and would go to Mt. Gox and get, 100 Bitcoins because, well, that's what we did at the time. Wish we had kept those, but that's a story for another day. And so a number of those exchanges were thriving. Mt. Gox certainly had the lion's share, but there were others. And those exchanges tended to be quite unreliable. So Mt. Gox is notoriously famous because they disappeared in February of, I want to say 2013, if I'm not, 2014 maybe, if I'm reading this right, where basically they left and a bunch of people that had money on the exchange, where they essentially had put, either US dollars in escrow at the exchange, or they had Bitcoins that were held in wallets hosted by the exchange. Well, the exchange just collapsed, leaving a bunch of people without their money. And if you are a customer of, say, well, any major US bank, and the bank goes belly up, at least in the US, there is something called the FDIC, which makes sure that for like your traditional accounts, you will be made whole, meaning you will be able to recover that money. There is some sort of insurance. That is not the case with cryptocurrency exchanges. So Mt. Gox was probably the most infamous of those because of its prominence. I mean, basically they had the biggest market share, but they were not the only ones. So this one was Bitcoinica. Some of you might remember this. A bunch of people lost money on Bitcoinica because of an improperly configured server. I mean, a lot of this was really fly-by-night operations. Bitfloor, number 4 Bitcoin-based exchange, shuts down for good. This is in 2013. Site was hit with a 25,000 Bitcoin worth $2.2 million now, where now is 2013. 25,000 Bitcoin is worth closer to about 600 to 700 million nowadays. So if those thieves were wise, they've just parked their money and now they probably enjoy a life of luxury. The largest exchange in Brazil got hacked. I forgot when this was, but this is again 2010, 2012. Mercado Bitcoin just went belly up. Bitmarket.eu in December 2012 had very bad news. This is basically the administrator posting on the Bitcoin forum saying that, yeah, sorry, oops, we made a mistake and we lost a bunch of money and well, we'll do better. BTCX went on maintenance in 2012. So BTCX was a pretty dodgy exchange. But they basically, again, left the ecosystem, taking a bunch of customers' money with them. So all of those are fairly early in the game, and you might be forgiven for thinking that, well, it's all in the past. Now we've got, reputable businesses like Coinbase or Kraken. Well, fairly recently still, this is 2019, Cryptopia basically lost a bunch of money and decided to, and I'll get back to that toward the end of this presentation, decided to just give a haircut to everybody who had an account on their platform. So if you held a wallet on Cryptopia, and let's say that you had some Ether on Cryptopia, well, you woke up one morning and your Ether was gone because the operators of the platform decided that they needed it to replenish their coffers. If you had Bitcoin, well, you only own 86% of the Bitcoin that you held the day before, because again, Cryptopia decided that they needed that money to replenish their coffers. This is fairly similar to what the government did, I think, in Cyprus a few years ago when they took money from everybody's bank accounts. And so it's kind of ironic that, those cryptocurrencies that were touted to be, the solution to this overreach from the government. Well, I mean, if you're holding stuff in an exchange, the same thing can happen to you. Again, fairly recent example of exchange misbehavior. Quadriga CX was the largest Canadian exchange, and in 2019, they basically disappeared, quote unquote, stealing $150 million in the process, although no one really knows what happened, and there is quite good evidence that this $150 million actually was long gone, the product of bad trades, and that they just disappeared because they couldn't pay. There's actually a very somber backstory to this, which I don't want to go too much into details about. But basically, the story was that the owner and operator of Quadriga CX passed away and was the only person to hold the private keys of the Quadriga CX wallets. And so they were like, well, sorry, the money is frozen, we can't do anything. Except that, as it turns out, that the private keys that were being held did not appear to control a lot of money. So it's possible that the money was gone anyway. Bitfinex, now we are talking about pretty large exchanges. That's 2016, got hacked and lost actually quite a lot of money as well, 120,000 Bitcoin back in 2016. So those now are, fairly large, fairly well-respected, so to speak, exchanges. So I wanted to summarize that on a slide, some of the notable hacks and losses between 2011 and 2019. Mt. Gox, 750,000 Bitcoin, Bitfloor, 24,000 Bitcoin, Bitstamp in 2015, 19,000, Bitfinex, Cryptopia, Quadriga CX, right? And even accounting for the fact that Bitcoin appreciated a lot over those years, you can see that the losses are actually piling up, right? I mean, that was the first Mt. Gox hack, by the way, in June of 2011. They went down in February of 2014, but the main hack was in June of 2011, before they went down. So all of this is actually quite, unnerving if you want to invest in cryptocurrencies. And so the first thing that I'm going to do in the reminder of this talk is to go back to a paper that we wrote. I said 2012, it's actually 2013. I can't cite my own papers anymore, but the study was done in 2012, where we were looking at exchange risk. And so what we did was, the ecosystem was still fairly small at the time. We looked at 40 exchanges that were active between 2010 and 2012. And we did a lot of gumshoe work going on forums to try to see why did these exchanges close, were there security breaches, were investors repaid, and so forth and so on. And the key measure that we used was the exchange lifetime. We wanted to try to see if we could predict whether an exchange was going to go belly up or not. So this was a fairly small study that we did back then, and the news was not good. About half of those exchanges closed, 18 out of the 40. They had a median lifetime of about a year, and out of those half of exchanges closing, about half did not reimburse customers at all. And this all predated the Mt. Gox scandal. So actually, if you look at this old paper, Mt. Gox is one of the quote unquote good guys in the sense that they survive, right? I mean, they're part of the measurement interval that we're considering, and they survive here. So this is kind of a wall of shame of those closed Bitcoin exchanges. Some of you may remember some of those names, like BTCX that I just mentioned. Some others you probably have never heard of, like Roxum or imcx.com. All of those went belly up in those short 2 years. And so what we wanted to do was to try to see if we could figure out which factors affect when an exchange closes. And when you do that, you start with hypotheses. So we sat down and we thought, okay, what do we think is a good predictor? We think that the more an exchange transacts money, like the more volume do they do on a daily basis, the less likely they are to shut down. We also think that if they've experienced a security breach in the past, the more likely this is going to cause a shutdown of the exchange. And the third point was that, and we had a little bit of a disagreement between the two co-authors there, but we thought that anti-money laundering compliance was probably also a good indicator, meaning that if the exchange is trying to implement some KYC, AML type of compliance, if they are upping their regulatory game, they are probably more likely to survive as opposed to exchanges that are trying to operate under the radar. And to test those hypotheses, we built what's called the Cox proportional hazards model. And so long story short, it's a statistical technique to figure out whether these parameters, are impactful or not. And the results were actually mixed. So daily volume definitely is a good predictor. It is statistically significant at the 0.05 level. The p-value is 0.0156 here. So it is actually a pretty good predictor. The more the daily volume, the less the probability that an exchange is going to close. The rest was not statistically significant. The probability of a breach seemed to be correlated, but statistical significance was murky, to say the least. I mean, we've got a fairly high p-value there. So it could have happened by chance. Qualitatively, I would say that it seems like, yeah, it seems to have an impact, but we definitely do not claim statistical significance. And for anti-money laundering, it was apparently pretty much uncorrelated. No significance one way or the other. So then what we did was to come up with what's called a Kaplan-Meier estimator. And what this does is basically it's telling you the probability that an exchange that you see today is still going to be alive X days from now, where X here is ranging from 0 to 3 years, because, well, I mean, that's what we had, what we could work with, right? 2.5 years, 3 years. And the survival probability decreases fairly quickly. On average, like I said, the median lifespan is probably 381. Here, the curve is a little bit, shows something slightly different, but basically, it gives you, a similar picture. And high volume exchanges like Mt. Gox, Intersango at the time were more likely to survive longer than low volume exchanges. So that's kind of what we found from this original study, but sometimes there are some lower risk exchanges that collapsed, like OKEx, or actually Mt. Gox collapsed about 9 months, I think, after we completed the study. So that certainly did happen. So I don't want to spend too much time on this very old stuff, but I just want you to remember this. 2010 to 2012, 45% of exchanges collapsed, often leaving customers unable to withdraw stored funds. In fact, half of those, so about a quarter of all exchanges, basically took money from customers down with them. And basically, the main finding of that study, the main robust finding of that study, there were a bunch of other small findings that I don't want to go too much into because they turned out not to be so robust when we redid those measurements later. But the main finding was that the bigger an exchange, the less likely it is to fail. Okay, that sounds kind of obvious in hindsight, but that's, the famed too big to fail, right? The problem is that the continued operation of an exchange meant that they needed to run a fairly high transaction volume, which in turn made them a more valuable target to thieves. So what this was showing is that in those early days, people who were successful were probably had more skin in the game, and so were doing a better job of trying to protect themselves, but also made themselves very attractive to thieves. So a couple of years later, in 2015, we thought, okay, well, the situation has changed a lot. 2015, for those of you who remember, crypto was becoming quite mainstream. That's actually when people started to use crypto for cryptocurrencies as opposed to cryptography. And so we published that study actually in 2018 because of the glacial pace at which journals review papers, which, you know, for those of you who are students in the audience, if you have measurement papers, don't publish them in journals, publish them in conferences, because the turnaround time is a lot faster. Be that as it may, the study I just reported on was written for between 2010 and 2012. So what changed after 2013? Well, what we noticed, and which was very depressing, was that at that time, we already did the whole thing. So we're not talking about 40 exchanges, we're talking about close to double that, 79 exchanges. And now it went from 45 to 48%. So there was no abatement of the trend. It got even worse, if anything. And again, 26 of those exchanges suffered security breaches. 15 of those who suffered security breaches closed. So we redid our regressions. We basically came up with more or less the same results. One new effect which was interesting was the availability of two-factor authentication, which in 2015 was still fairly new. That indicated a lesser chance of a breach, meaning, and here I'm being very qualitative, if you were very serious about security, it seemed to bear fruit. Transaction volume remained a statistically significant indicator of failure. So why did I go over all of this? I went over all of this because surely more modern exchanges must be more reliable if we set aside, you know, bad actors like QuadrigaCX or Cryptonia. And surely in those short 10 years, we went from, you know, those Far West banks that kept on getting robbed to something a little bit more modern and a little bit more reliable. So are there other risks in leaving your money on a Bitcoin exchange? Again, in the early days, people lost money to exchanges because those were hacked or closed down and absconded with customer funds. But is outright theft really the only way you can lose money on an exchange? So we're going to jump 10 years into, not into the future, but 10 years after the previous study, and we're going to talk about cryptocurrency derivative trading. This is a well, not brand new, but this is a fairly new way of losing your money very, very quickly if you're so inclined. I put this quote here. It's actually, I usually don't do that, but I'm self-quoting here because I thought this was cute. I got interviewed by a reporter about this paper. It was like, what can you tell us about those markets? And I wasn't really thinking, I just blurbed, you know, well, some people get rich very quickly, some people lose their shirt very quickly, and some people do both in the same day. And that's really, you know, the story of what we are going to look at. So if I go back to my exchange timeline, after those fiat exchanges like Mt. Gox and Bitstamp became quite popular, some other exchanges started to allow for what's called margin trading. So I'm going to discuss leveraged and margin trading in a lot more details in a few slides. But essentially what margin trading allows you to do is to borrow money to trade. So the typical example that people use is you want to trade $100 of a certain commodity, but you only have $20. What do? Well, you give your $20 to the exchange and you say, hey, I really would like to trade 100. So they're going to give you something that's called leverage, which is 5x. You can trade for 100, but they're going to use your $20 as a collateral. And so this is a way for people to essentially borrow money somewhat artificially from the exchange to trade higher volumes. In a second, I'll explain how this works. It's actually fairly scary when you think about it, and I will go into some of the unfortunate side effects of this leverage trading toward the end of this talk. So this was fairly new in 2012, 2013. Bitfinex was actually one of the first to propose it. And what really was new, what was, you know, kind of a game changer, was the appearance of this guy here, BitMEX. Right? So BitMEX appeared in late 2014, and they created a bunch of derivatives, new contracts, in particular things called perpetual swaps, And they are super important because even though BitMEX nowadays is, honestly, it's an also ran in today's market. The big ones are Binance, FTX, and OKEx, and a couple of others. BitMEX at this point represents a very small volume. But what is interesting is that they were the first, and they actually popularized those financial instruments that most of those markets nowadays use. So by looking at BitMEX, you can get a very good representation of what's going on in the infancy of this new ecosystem. And by the way, I don't have a slide that shows that, but nowadays derivatives currently, I hope I'm not wrong when I'm mentioning that quote, but they represent about 5 times as much trade as what you see on spot markets, right? So derivatives and futures are probably about 80% of cryptocurrency trading today. So what were those?
I have a quick question, if you may.
Yes.
So I was wondering already before, it seems like Coinbase is not listed on that slide. Is there any particular reason for it? Or
no, so Coinbase is basically a spot market. Coinbase does not really do futures or derivatives. They tend to be, Coinbase is basically your grandpa's exchange.
Okay.
No, we didn't list it on this slide because they're basically, the 2021 version of Mt. Gox, so to speak, as being the dominant exchange for US-based people. The difference is that they are very, very they're very compliant. They definitely spent a lot of money doing all of this compliance work, and that's why it led them to this ICO. But they don't do risky stuff like allowing you to trade, contracts between, say, Doge and well, they do actually crypto to crypto, but they don't let you trade Doge futures, for instance, or anything like that. So they are interesting, but this is not where a lot of the trading action takes place. Okay. Surprisingly. Yes, this is where a lot of spot trading takes place, but as we will see, this is dwarfed by the amount of money that is circulating through something like Binance futures. Okay, thanks. So if you were interested in trading in futures in, say, 2018, or even, let's say 2018, which is when BitMEX really started to pick up speed. What happened in 2018? Bitcoin lost a lot of value, right? I mean, there was a peak in late 2017, and then it went from like $20,000 down to probably 10 first, and then 7 or 8, and then it's continued to peter out. So if you're holding Bitcoin, what do? You're like, I'm losing money. So what people really wanted to do was to be able to short Bitcoin. What that means is that you're betting against the value of Bitcoin. And BitMEX became quite popular because they actually gave you a very clean way of doing this. You didn't really have to go and borrow Bitcoins to try to resell them. You just bid on those short contracts. So if you wanted to connect to BitMEX, so all of you who are in the UK, good for you. As long as you're not US citizens, you could go in there and happily go and lose your money. If, like me, you were in the US, what BitMEX would do was to see that you were connecting with a US-based IP address, and they would not let you connect. That's fine. I have a PhD in computer science, and therefore I know how to use a VPN. So I could use that to connect to BitMEX. I didn't connect to BitMEX to trade, but there was very little enforcement available. Essentially, all you needed was a non-US IP address and an email address. And that's all that was needed. No passport, no nothing. When people put money in BitMEX, what was also very interesting with BitMEX, and which was great for researchers like ourselves, was that they used vanity addresses that all started with 3 BMX. And so we could identify those very easily as being BitMEX addresses. Of course, you get a few false positives. Some addresses might start with 3 BMX spuriously, but you can filter them out fairly easily. So we know which Bitcoin wallets are actually BitMEX addresses. And internally, you do your transactions, and only when you withdraw money, then you can see it coming out of those accounts. So you can't really estimate the wealth of somebody by looking just at the account, because this is telling you that money is being put in, but then internally BitMEX might actually do some transfers from some of those addresses, and specifically when people settle. So we built an engine to actually monitor what was going on, and this is the engine whose results I'm going to present in a few minutes. But before I do that, let us take a small detour and explain what those contracts that are being traded really are. So I'm going to use a simplified example of the most popular financial instrument used on BitMEX called the XBTUSD perpetual future. We have two traders, let's say Philip and I, or Alice and Bob. Alice wants to go long on Bitcoin. She thinks that Bitcoin is going to appreciate. Bob, who is probably just a shill for Warren Buffett or Donald Trump, thinks that Bitcoin is a scam and wants to short it. What that means is that they want to bid against Bitcoin. And they agree to trade a contract with a value defined to be $1 worth of Bitcoin. So I know it's not the real value, but it's going to make our computations a lot easier. Let's assume that Bitcoin is worth $10,000, which it probably was when we designed this slide the first time. The contract would be worth 0.0001 Bitcoins. Okay, so that's the value of one of those contracts. And they shake hands. Today is June 10th. And in the future, at some point, they will want to settle. Okay? At that point, the long payoff will be the initial contract Bitcoin value minus the final contract Bitcoin value. So if Bitcoin appreciated, for instance, Bitcoin now is worth $100,000, the final value of the contract denominated in Bitcoin becomes 0.00001, right? So 1% of its original value, and the payoff of the contract to the long side is 0.0009 Bitcoins, okay? So it's $1 worth of Bitcoin. Originally, it was 0.0001 Bitcoin. At the end, it's 0.0001 Bitcoin. Alice made 9,000 Satoshis. Bob, who is on the short side, lost 9,000 Satoshi because the short payoff is computed exactly as the opposite. It's the final contract value in Bitcoin minus the initial value in Bitcoin, which means that if Bitcoin appreciates, the short payoff is going to be negative. So far, so good. That's your basic contract, one-on-one correspondence, nothing fancy. But remember what I said about leverage and about margin trading? Let's say that the current price of Bitcoin is $10,000 to the Bitcoin. And let's say that Alice has 0.1 Bitcoin of margin in her account, and Bob has 5 Bitcoins of margin. So Bob has quite a lot of money. He's got $50,000 worth of Bitcoin. Alice is poor. She only has $1,000 of Bitcoin. But Alice wants to go long and Bob wants to go short. And we reuse the contract that we had before, the XBTUSD perpetual future. And we're considering now 50,000 of those contracts. Why 50,000? Well, that's roughly, not roughly, that's exactly corresponding to 5 Bitcoin, right? So Bob wants to go short 5 Bitcoin. So he's saying, okay, I'll take the short side of those 50,000 contracts. Alice wants to take the long side, but she doesn't have enough money, right? She doesn't have 5 Bitcoins. She has 0.1 Bitcoin, which means that the value of those contracts exceeds Alice margins by 50x. The platform will let Alice trade. They will take those 0.1 Bitcoin that she has in her account, and they will let Alice trade. But Alice now has a leverage that's called the 50x leverage. So what does that mean? That means that before, for Alice to be ruined, Bitcoin literally had to go down to 0, right? When she was doing one-to-one trading. Now, because she's 50x leverage, a 2% drop in the value of Bitcoin would cause her ruin. Okay? So that starts to be fairly dangerous. So let's look at payouts if everything goes well for Alice. When the contract was started, the Bitcoin was worth $10,000. At closing time, now the Bitcoin is worth 12,500. Why did I choose that? Well, let's see. Those 50,000 contracts, originally they were worth 5 Bitcoins, now they are worth 4. They are worth 4 Bitcoins. So Alice is on the long side. She's just mined 1 Bitcoin with this leverage trading. That's pretty cool, right? I mean, she basically managed to get 1,000% return on investment because Bitcoin appreciated. Why? Because she was super leveraged. So now she has 1.1 Bitcoins in her account after settling. Bob lost 1 Bitcoin, right? Originally, the contract was for 5 Bitcoins. Bitcoins appreciated. Bob was on the losing side of the trade, and now he has 4 Bitcoins. But because Bob was 1x short, essentially what he's doing is that he has constant USD exposure. Originally, he had 5 Bitcoins. They were worth $50,000. Now he has 4 Bitcoins. They're still worth $50,000 in USD. So that's actually kind of interesting because he was short, but in dollars, he didn't really lose anything. He lost some Bitcoin, but you know, it's probably okay for him. So Alice here just made a lot of money. Good for her. But what happens if Bitcoin, instead of climbing to 12,000, shortly after they make this trade, the Bitcoin goes down to 9,800, right? So it lost 2%, give or take. What that means is that the 50,000 contracts, which were worth 5 Bitcoins, now they are worth 5.1 Bitcoins. Well, Alice had 0.1 Bitcoin. That 0.1 Bitcoin is gone. She has 0 in her balance. And what that means is that she gets liquidated. In practice, what that means is that the exchange looks at it and says, okay, Alice cannot continue because she's lost everything. The contracts are closed. They're automatically settled. Bob gets the 0.1 Bitcoin that he won from the short. And Alice is zeroed out and told, hey, if you want to play again, you need to put more money. So Bob contracts are also closed in what's referred to as auto-deleveraging. And this is going to be important in the near future when I talk about the bad effects of liquidations, because those positions are closed. They are liquidated, right? So if you remember some of the big trading scandals in the 90s and in the 2000s with people, losing billions of dollars on behalf of a bank, that was usually because somebody noticed that something very bad was happening and forcibly closed the positions. So forced closures can result in bad side effects, but there's no way of doing it otherwise. So here you'll see that there is a footnote at the bottom saying, this example ignores maintenance margin and other parameters. Usually Alice does not reach 0 before being liquidated. She is at epsilon, slightly above 0, because the exchange wants to take his share of the account. But I simplified the exchange here. I simplified the contract here for the purpose of explaining it. But it's basically not that much more complicated in practice. So Bitcoin implements a market for those contracts using a standard order book model, where you say, okay, I'm willing to pay that much for this contract. I'm willing to buy this contract for that much, or I'm willing to sell a contract for that much. So this looks and feels like a typical spot market, but with leverage and the ability to short it. Leverage on BitMEX, when we did the study, was allowed up to 100x for initial margin and up to 200x or more on XBTUSD for certain customers. Other contracts might have lower leverage limits. For instance, I don't think you could leverage Dogecoin 100x. But these instruments can be traded on anything, not just Bitcoin, right? So you can have stuff like that is, Ether versus USD, Bitcoin versus Ether, and so forth, right? So we wanted to look at the dynamics of BitMEX, and we got 3 sources of data. The first one was the blockchain. We gathered data for 7 years from the blockchain, looking at 3 BMX accounts, and this corresponds to over 600,000 accounts, more than 20 million flows of transaction, and more than 6 million Bitcoin being involved in those transactions at one point or another. The largest account exceed the price of one pizza, 10,000 Bitcoin. The most profitable traders could probably buy about 8 pizzas because they made 40,000 Bitcoins in profit. We complemented this with a measurement study of the Trollbox. The Trollbox is basically a BitMEX site-wide channel where people post stuff. And notably, they post trading positions, they post, bragging rights. There is a bot that informs people that somebody just got liquidated. So it's very good as a liquidation signal. So we looked at the Trollbox as well. And finally, we looked at the price and the volume for 265 instruments and 212 indexes, plus correlating that to the spot price from Coinbase, Kraken, and Bitstamp. So what we noticed, the first thing, is that BitMEX, as you could expect, thrived in a bear market, right? In 2018, if you look at this graph, shows you the Bitcoin exchange rate for US dollars, and you see it's all red, right? For most of 2018 going into 2019, Bitcoin just day in, day out was losing value. And that's when BitMEX really started to pick up. Initially, we see just a few accounts. And then after the big bubble of late 2017, we see that the number of accounts jumps into the 20,000, 30,000, and even more. And that continues throughout. And what's interesting is that when the bear market is over, we still see a lot of account activity because now people have been hooked, right? They're like, hey, we can make money, and sure, it's picking up, but that's fine. We can trade on those contracts. We can just go long. So you might wonder, why did it go down when things got really spicy at the end? And the answer is the US government started to be very interested in BitMEX and indicted the 3 co-founders in November of 2020, just when we finished writing our paper. Coincidence? Yes, coincidence. We had nothing to do with that. But they basically are under indictment for not doing a very good job at doing customer KYC type of enforcement, what I talked about earlier. The SEC really didn't like it and said, hey, look, you should have done a better job. Most platforms do not let US customers on exactly for that reason, but BitMEX was basically not really checking very, very carefully, and that's why they got in trouble. And so that's why the number of accounts decreased toward the end of the measurement interval. What we do here is that we're plotting as a function of time the daily volume traded in notional US dollars. And what you see is that this is dominated by the Bitcoin to USD futures. So perpetual Bitcoin futures are the share of the lion. We do see a little bit of another instrument called the settled Bitcoin future that I'm not going to go into too many details in, but basically it's perpetual futures, green Bitcoin, blue Ethereum, and the rest is just very, very small in terms of activity. So in terms of customer deposits, so this is very interesting because this is going to be one of the 2 main findings from that paper. What we see initially is a somewhat even distributions between small accounts in green that hold less than 1 Bitcoin, medium tier accounts that hold less than 10 Bitcoin, purple accounts that are somewhere between 10 and 100 Bitcoin, and mega rich accounts that have more than 100 Bitcoin. Those are small, right? I mean, initially there's just a few people with those very large amounts of Bitcoins. And the vast majority of the market is small to medium tier people with a few large tier, like the 100 Bitcoin people. So think of it this way. There's the mega rich in red, the rich in purple, the medium in yellow, and small investors in green. And what you see is that there was a big sell-off in November 2018, and a bunch of people lost a lot of money. Who lost money? Well, mostly the small guys, right? The number of accounts just precipitously decreased, but most importantly, the medium guys that are at 1 to 10 Bitcoins. Who profited from it? The purple and the red. What this suggests is that money kind of migrated from retail investors to larger investors like hedge funds or professional investors. And we see this trend kind of, repeating itself with the very large accounts acquiring more and more wealth over time and kind of, swallowing up the entire ecosystem. There's some quirks in the data. Here we've got a rapid drop, which is somewhat interesting because what happened is that BitMEX merged a bunch of accounts. So this one's a little bit artificial. It's not just people losing money, it's also internal reorg where they decided to combine some accounts. And what we see at the end is the USD-AUG indictment created this big loss in accounts that is still going on today. So another way of expressing this is with this heat map. So again, I'm plotting, here the Bitcoin exchange rate, but what I want you to focus on is the colors in that heat map. What they show is basically the fraction of all accounts in a given tier, and the tiers are represented on this side of the graph. And what you see is that early on, you get a lot of activity at fairly low volumes, 0 to 10 to 100 Bitcoin. And then what you see is somewhat magically, this yellow bubble is moving up. What that means, again, it's the same thing as on the last slide. It's a different visualization. You see small accounts being essentially fleeced. Well, fleeced is perhaps not the right word because they know what they're doing. I mean, no one is stealing their money, but the money is being lost to people who have more Bitcoin in their accounts. There's a lot of 1,000 Bitcoin accounts, as you can see. This may be a little bit artificial. It's larger accounts that are being broken into smaller units. So you can kind of ignore that bright yellow line. But really the story is to see this going up here and then, kind of getting spread even higher in the sorry, I'm just realizing that I wasn't pointing with my mouse. Going even higher in the tiers. What we also noticed is that large sophisticated traders use multiple accounts, right? I mean, this is kind of what's showing with that yellow line. And basically they use cluster. I mean, when we cluster accounts by looking at, money going in and money going out, so we did something fairly similar to what Sarah Michael-John did a number of years ago doing Bitcoin tracing analysis. We tried to see what are the 3 BitMEX accounts that are somewhat related to each other, and doing that, we can cluster them and realize that, yes, there's a bunch of people with singletons, but those tend to be mostly, for people who have small balances. People who have large balances, they tend to have cluster sizes that are 6, 10, 11 to 15 accounts. So we also looked at the Trollbox, like I said earlier, and one very interesting finding was that there were more posts on the Trollbox than on Reddit between 2018 and 2020. So people like Emiliano might want to look at the Trollbox now. There's less nastiness. I mean, it's just about people losing money and other people making fun of people losing money. But this was an incredibly active chat box. And we spent a lot of time trying to do sentiment analysis. I have a slide on that I decided to cut from this presentation, but basically the sentiment on the Trollbox kind of trails the value on the spot markets by about an hour and 15 minutes. So you cannot use it as a predictor, but it's a very good way to see, what kind of memory there is in the system. And basically, these traders have the memory of a glorified goldfish, right? I mean, a little bit over an hour. That's for the people participating in the Trollbox. But what's more interesting is this plot. This plot shows activity broken down by language. So English is kind of boring because everybody speaks it. And so you would expect a fairly uniform distribution over all time zones. What is super interesting here is Korean. So here I'm using a stacked plot, so that kind of obscures the effect a little bit. Unfortunately, I should have redone this. But what is really telling is that Korean is not as time zone variant as you would expect. There's basically one time zone where people speak Korean. Yes, I know there's a lot of Korean speakers in Los Angeles, but compared to the population of speakers in the Korean peninsula, it's still very small. So basically, most of those people, an overwhelming majority of Korean speakers, are in one time zone, Korean Standard Time, KST. But when you look at the distribution of the messages, they're all over the place. So what does that mean? Does that mean that there's a lot of people who speak Korean in the States? Yes, but a more plausible explanation is that the people who are trading in Korea do not sleep, and they're trading obsessively. And that's actually an interesting finding, because this means that we have gamified this. In fact, BitMEX was initially referred to as Arthur's Casino, after Arthur Hayes, one of its founders. And like in a casino, if you go to Las Vegas, you will see people gambling at 4 in the morning. You will see the same thing here. And it's a little bit concerning to see this kind of obsessive trading behavior. BitMEX has been notorious for large liquidation events, but I'm going to skip this because I'm out of time. And I'm going to, again, reinforce that point that we see mostly, so we see long liquidations exceed short liquidations. So people were betting on Bitcoin and lost money, probably because they were leveraged and Bitcoin just lost a little bit and that wiped them out. People who tend to short tend to be usually more people who have more money, and so they tend to lose less. But what was most interesting is if you look at this curve, which is basically a CDF of the liquidation size versus the cumulative liquidation volume, if you look at the second derivative, it's negative. And what that means is that the smaller position comprise the larger volume. There's a jump at the end. So whenever there's a jump like this, you should be very skeptical of what's going on. And this is happening because BitMEX has a hard limit. Contracts are limited to $10 million. So, you cannot get liquidated for more than 10 million. You might get liquidated for like 3 or 4 lots of 10 million, but not for 10 million. So the last thing that I want to mention, and I only have 2 minutes, so I'm just going to blaze over it, is the issue of socialized losses. One of the liquidations that I talked about was the OKEx liquidation. What happened? Remember what I said about leverage trading? So Alice was this poor person who only had $1,000. What happens if somebody wants to play with very high leverage, but has also a lot of collateral? Well, guess what? This happened. A trader put $21 million, but they didn't want to trade 21 millions. They wanted to trade 400 millions. So they requested 20x leverage on the OKEx platform. Unfortunately, they were on the wrong side of the trade. They got liquidated. That's a lot of money to liquidate. And what this caused is basically a spillover effect where the spot value of Bitcoin actually decreased because they had so much to sell. And because OKEx was not prompt enough to sell these liquidated contracts, the exchange was actually on the hook for $25 million. And what that means is that, well, they socialize the losses. The house never loses, right? Remember that. So OKEx was not going to lose money. Instead, what they did was, hey, Philip, you were trading short. You won a lot of money. Guess what? We're going to tax you a little bit from it. You didn't win as much money, right? So they recovered from the gains of traders who made money. That seems a little bit unseemly, but to some extent, it's a little bit more moral than what Cryptopia did, where they socialized losses based on holdings. Like they just took money from everybody, whereas at least OKEx took it on profits. So to conclude, I hope that I've dissuaded you from doing cryptocurrency trading. It's really not for the faint of heart. If you own some cryptocurrencies, it's probably better to own it, locally in a wallet that you control. If you want to trade, think of it this way: you're going to Las Vegas, you're going to a casino, you're probably going to lose your money. If you're having fun doing that, that's great. By all means, go for it. But unless you're a large investor or a hedge fund, you have to be fairly lucky to make money. The game is pretty much rigged. And there are other ways you can lose your money. So I'm going to finish by just giving you access to the papers which are on my webpage. But the coolest thing that we've done in the past year is to have a website, cryptotrade.cim.edu, where you can play with all of the data that I talked about in BitMEX. Some of those graphs are annotated. Have fun, just enjoy. There's basically all of the paper and more on that website. And we are more than happy to make the data available. Well, the data that we can make available. So that means probably not BitMEX Trollbox, because they're like, you guys shouldn't redistribute this, but like the on-chain data and all of that, we're more than happy to make it available. I'm out of time. I'm sorry, I'm running behind, but I can stick around for a few questions now if that's fine.
Excellent.
Otherwise,
yeah.
Thank you very much.
Thanks a lot for the great talk. It was really super interesting. I will stop the recording and then we can switch over to the Q&A.
Sure. Thank you.